Welcome to Budget Control. A budget is only as good as its implementation. This module examines budget control. Today we'll examine adoption, or the formal allocation of money, expenditure limits, or the assignment of control points, chart of accounts, or the importance of coding every transaction, spending pace, or the allotment of money by time period, inflation, or how to assess its impact on the budget, and finally events, or managing unexpected changes in supply and demand. Adoption refers to the formal approval of the budget. Who has budget adoption responsibility? Is it the laboratory manager, the head of the clinic, a regional authority, or perhaps a central government agency? We might call this person or agency the approving authority. It's only after the budget has been formally adopted that spending can occur according to the plan. In government budgeting, no obligations can occur until the budget is legally adopted by the approving authority. What flexibility does the approving authority have to change the budget before it's formally adopted? Can it be rejected in all or part? Can items be substituted or revised? Can fee levels be imposed or changed? What about salary or wage levels? During the year, what authority does the approving authority have to change the budget? Can changes be imposed, or is there a requirement for cooperation and sharing of ideas? If the approving authority is ultimately responsible for the budget to finish the year on target, it makes sense that any mid-course correction should also be part of this ultimate responsibility. Expenditure limits can be exercised at different levels of the organization. What are expenditure limits? Expenditure limits define what accounts may be used to pay obligations. The red arrow here illustrates that control could stay at the organization level. That's termed a macro control, which allows spending out of any account. Or it may go all the way down to the line item level, termed a micro control. This limits certain obligations to a single account. Macro control gives the most discretion to managers and staff on how to use funds, while microcontrol takes away the most discretion. Program level control puts spending limits at the level that often crosses departmental boundaries. For example, a program that provides HIV services might involve some or all of the various departments in a large clinic. The program budget would include part of the front office intake department, part of the counseling department, part of the testing service department, some of the inpatient services department, and part of the follow-up client services unit. As this might suggest, a program level control may make it hard for each department to control its own budget, since so much of what happens is a function of the interaction between departments. It only takes one department to make a mistake, for a client to be delayed, or the budget to get off target. Tracking and controlling budget elements by department is the traditional method of control. It places responsibility on the department manager to meet the budget for that department. But as the prior example illustrated, if another department's activities, or worse, non-activity, influences your department's budget success, then you're dependent on their level of work. Thus, even departmental level controls are not completely separate from other departments. Expenditure line items are the most constraining level of control. That means that the line item for office supplies, for example, cannot be exceeded without approval from the approving authority. For that reason, controls on expenditure categories, which make up multiple budget lines, make more sense. It balances control while allowing some discretion. Instead of placing controls on office supplies, continuing the example before, control is placed on the more encompassing supplies category. As this discussion suggests, there are competing pressures to use more macro or more micro controls. All too often, organizations desire to use more macro controls, but then some wayward employee messes up and the negative headline news makes the organization tilt back to micro controls to avoid future negative headlines. Every transaction, whether an inflow or outflow should be assigned a number that allows it and others like it to be sorted in a uniform manner. Financial reports depend upon a systematic recording system known as the chart of accounts. These charts of accounts differ by organization, but they all enjoy certain common characteristics. Here is a sample chart of accounts. This example indicates a 4-digit fund number, which is the first 4 numbers, a departmental number, which is the middle 2 numbers, and the line item account number, which is the last 4 numbers. As we mentioned with the prior slide on expenditure limits, spending control can be exercised at different levels. Well, the chart of accounts shows how to do that. If the control was on the line item expenditure level, such as office supplies, then any item coded as 1101, 01, 5301 would be subject to strict spending control. Alternatively, control on the expenditure category of supplies would focus instead on items coded in the grouping of 53 in the number series 1101, 5300. You'll notice that not all numbers are used. It makes sense to leave some number gaps, as they allow for future changes in accounts used in organizational activities. Not every budget in an organization will use exactly the same line item accounts. They may all have salary lines, but only laboratories might have a need for a separate supply line for CD4 cartridges. As a result, every organization keeps a master chart of accounts which lists all of the line items set up for possible use in a budget. This slide shows an example of a section of a master chart of accounts. Definitions of each numbered line item are needed to ensure that the coding of each expenditure is done properly and into the right account. If expenditures are not coded to the proper account, then generating accurate reports of, say, how much has been spent on CD4 cartridges or how much has been spent on office supplies becomes very difficult. It impacts both management decisions and transparency. Showing here is just part of a much longer definition listing. It helps to clarify some of the accounts, such as 5102, the overtime account, or the account number 5301 for office supplies. As with our own household budget, we know that if we spend all the monthly paycheck early in the month, we won't have any money left to spend later in the month. Thus, we have to pace our spending as much as possible. The same goes for the organization's budget. In government agencies or grant-dependent organizations, the approved budget has to last for the entire year. We cannot overspend because there may not be any alternative sources of funding at year end. And often we don't want to underspend. This calls for some sort of spending pay schedule. An allotment schedule is where management makes funds available to a department or program on a basis other than annually, such as monthly. This means that in January you'd be given only enough to cover expected spending for that month. If you've exceeded that control level, then you'd have to cut spending out of your February budget in order to make up the funds. Here's an example. It shows the budget progress report for the end of the third quarter of the budget year. We'd expect that 75% of the spending plan would have occurred by now. But it shows that only 66% has actually been expended or obligated by this point in time. The total budget for the central laboratory, chart of accounts fund and division 110101, is $90,900. Actual expenditures to date total $54,469. There are encumbrances, which are authorized obligations against the budget that haven't yet been paid, of another $5,558. The sum of actual expenditures and encumbrances totals $60,027. If we divide $60,027 by $90,900, we get 66%. Looking at the account line items, however, we see significant variance in the percentage spent. The account 5399, non-capitalized equipment, is at 100% of the annual amount. This could be as expected, with the purchase of a single item of $3,000 having been planned. This 66% is less than the expected 75%, so the budget is in good shape. If this spending pace continues, the department is likely to end the year without needing all of their approved budget. Whether this is good or bad depends upon the services performed during the year. Management should look into each item. Did demand fall short of expectations? Or was the cost of providing services lower than expected? Why were salaries less than planned? These are the types of questions that might be looked into in order to understand and plan for the following year's budget. Unanticipated high inflation during a year can make a mess of the budget. Tax receipts may grow with inflation, especially if the tax is on income. Consumption taxes may grow as commodity prices increase. Collections from fixed fees are likely to lag inflation because it may be harder to keep changing the fixed fee rate. The last problem is different from income and consumption taxes, which also may keep a fixed rate, but in their case, the taxable item grows with inflation, thus increasing the collections from those taxes. Annual transfers from governments or fixed grants from donors or others are not designed to keep pace with inflation during the year. So inflation means that those dollars fund fewer services than originally planned. In terms of expenditures, wages and salaries lag inflation unless there are automatic adjustments. Even then, the adjustments are frequently only yearly. So if the inflation expectation built into the annual budget is wrong, you have to wait until the next annual budget cycle to make adjustments. Supplies and services track inflation. Vendors often increase their prices frequently during inflationary periods, so your fixed annual budget is likely to buy less than expected. For these reasons, it's best to consider inflation when building a budget. Countries track inflation by pricing a common market basket of goods and services every month. Changes in what it costs to buy or rent that fixed set of commodities and services each month is then converted into an index. The market basket that cost 100 monetary units last month may cost 110 units this month, thereby representing a 10% cost of living increase. The price index may be termed a consumer price index or a price deflator. Here is an example of how to use an index. In this example, there are 3 years of budget year data: Year 2, Year 3, and Year 4. But realize it could be monthly information if the inflation index is monthly, and that level of detail was useful. The budget amount for each of the years is shown, with the Year 2 budget at 1,530. The percentage change, calculated from that year to the next, is 1,582 minus 1,530, then divide the result by 1,530. And convert to a percentage by multiplying by 100, and you'll get 3.4%. But what is the change after inflation is taken into consideration? In this example, the market basket base year was 2015. So the entire basket could be purchased for 100 monetary units then. But in Year 2, it cost 118.3 units, or 1.183 times the base year. Now divide the budget amount, termed current, by the index. So that's 1,530 divided by 1.183, with the result being 1,293. Repeating the same process produces the real column, which shows how inflation has dampened the growth curve. The change from Year 2 to Year 3 represents a loss of purchasing power of 1.3%, despite the current amount of the budget increasing 3.4%. The overall budget change over this 3-year period is not nearly as steep as the current change column shows. As the notes at the bottom suggest, it's possible to restate the price index to a new base year. Annual budgets are premised on expectations of supply and demand. But things can go wrong during the year. As a result, you have to be ready to manage the unexpected events. There may be a surge of demand caused by an epidemic. or you may have more clients or patients than expected. In preparing for that possibility, you should have plans in place to be able to call on part-time providers with the skills you need to operate. You may have to reschedule discretionary visits or client appointments. Managing the queue is critical. This may entail changing the production process to handle more people more quickly without jeopardizing quality. In terms of pricing, a form of surge pricing may be hard to implement. What this would require is for you to manage demand by charging more. The more you increase fees for services, the more likely it will deter people from seeking those services, thereby reducing demand. Of course, this is not likely to work given that those most in need have little ability to pay. As a result, surge pricing in healthcare can raise serious ethical considerations. How do you handle a plunge in demand? A new lower spending level has to be put in place, including freezing purchases and stopping any discretionary spending. What if there is an erosion of service effectiveness due to a loss of skilled staff, for example? In this case, there would be salary and wage savings, but a loss of ability to meet demand, and likely reducing revenue as well. In all of these scenarios, it's best to involve everyone, staff, clients, and the community, in communicating how the agency will make changes. All employees must rally around the changes, with responsibility handed out around the table. Timely reports help ensure that corrective action is being taken and that revised budget goals are on track to be achieved. Sharing this information with the entire staff helps keep everyone moving in the same direction. Regardless of the type of problem that has emerged, whether it's due to a surge or a plunge, the lesson is to improve the organization's ability to balance supply and demand going forward.